Well, good morning, everyone, and thank you for joining us this morning for our CattleFax market update and outlook. As a quick reminder, all attendees are muted and videos are shut off. However, we'd love for you to engage with our presenter today using the chat feature found at the bottom of your screen. Before we begin, I'd like to introduce our expert on the call today, Patrick Linnell, with Director of CattleFax Market Research at CattleFax. Within his role, Patrick watches trends within the industry, serves as a speaker at many conferences, including many of ours over at Farm Credit Mid-America, providing insights and updates, and works with farmers and ranchers to understand their risk in the industry. As a reminder, this webinar is intended for informational purposes only and is not for public or media consumption. Any opinions expressed by the presenters are their own and do not necessarily reflect those of Farm Credit Mid-America. So with that, thank you all so much for joining us. And Patrick, I'll turn it over to you to take it away.
Perfect. Thank you, Micah. Are you seeing my screen?
Yes, sir.
Perfect. Well, thanks again for the opportunity to be with you all again as we walk through this market update. Micah and I were talking through a few of the questions that were submitted ahead of time just a few minutes ago, and there certainly was quite a few really good questions here that we'll try to address going through the outlook, and then also save some time for any other questions that anyone has going through the information here. And looking everything from big picture where we're at in terms of the cycle to these more near-term considerations and what's going on with the market. So as we just start chalking the field, as far as where we're at in the cattle cycle from a very macro standpoint, I believe I've likely shared this slide here before with the group, but I think it is just a useful benchmark. And again, no cattle cycle is perfect, but they all, over time, really since the early 1900s, they've tended to play out in roughly 10-year patterns. And as far as where we're sitting today, it would likely be somewhere in this range. And again, knowing that, as we'll talk through in a few minutes, but we are pretty well up the ladder in terms of price. Again, with the big surge that we've seen, but we still do believe that there is price firmness ahead of us on average here over the next, at least next year, and potentially a few more beyond that. But in terms of the cow inventory in the industry's factory floor, we believe we still haven't quite seen the low yet. And as we'll talk through, we have that penciled in on January 1 of 2025. So this to begin this upcoming year. So as we think about where we're at in terms of drought, again, nearly every part of the country at some point in the past couple of years has dealt with drought in a pretty substantial way. But this spring moisture that we've had coming in across nearly all parts of the country has dramatically turned that picture. Now, again, we do have some spots of drought showing up into Montana, southwest Kansas, the Oklahoma Panhandle, and then down there into the southwest, western Texas, and into New Mexico. But by and large, as you look across the country, most folks in pretty good shape. And that really will pave the path for, again, that question of heifer retention, especially this fall. Again, thinking about the fact that roughly 75% of the nation's cow-calf operators are spring calving. So really, again, those retention decisions here this fall will be the big changer and the big driver as far as what the next few years have in store. However, as I'm sure you all are aware, and most meteorologists out there are waving the caution flag relative to the La Nina El Nino cycle. And El Nino is gone, in which tends to bring in those wetter patterns to the Central Plains. And we're sitting here in neutral territory today, which often, as you're transitioning from El Nino to La Nina, many would suggest that means that often you can have these volatile weather patterns that often do bring precipitation. But as you do transition through the fall, or through the summer and into the fall, the probability of transitioning back into that La Nina phase increases pretty dramatically. And so we do have to think about what implications that has. And really what it comes down to is both which regions are impacted, as well as the timing. And does it come on earlier in some of the heavy cow-calf regions, or are they in decent shape through the late summer and fall, and it really hits into the fourth quarter? I think as you do look back at the nation's cow herd and cyclical inventories, I think this is a pretty useful illustration and really interesting as you think about the impact of drought and the nation's beef cows. Now, one observation here, you look at the last 25 years or so, and there is no doubt that the nation's beef cow industry has dealt with drought in a big way, and both more frequently and more severely than if you look at the roughly 40 years before that. Now, another observation here is, in, can the beef industry expand during drought? And if we transition back into that La Nina phase for the second half of this year, in particular into the fall and winter and into 2025, can the nation's beef cow herd expand? Well, in recent history, that has not been the case. But you look back historically, and certainly the worst drought since the 50s, the nation's beef cow herd was growing. Now, again, was that a dramatically different world than the one we live in today? Arguably so. But you can spot some other times throughout history where we did expand into a drought as well, again, on a couple year basis. So as we look at this data, suggests to us that yes, as we look towards heifer retention patterns and cow culling this fall, but we do believe that we will enter a mild expansion pace. Drought will be a headwind and likely limiting to that pace, but stay tuned on the degree. So to that discussion of this expansion pattern, what exactly does it look like? You know, us and others in the industry have been talking about this expansion coming on for some while, and it really hasn't unfolded yet. So will it happen here in the near term or not? So we'll talk through the two levers here to get the trajectory of the nation's beef cow herd. One, how many cows you're culling, and then two, how many heifers the industry is retaining. So as you start looking at beef cow culling rate, and the number of beef cows making their way to slaughter, down dramatically this year. Our forecast is that as the year is done, we will drop beef cow slaughter by over 500,000 head, or roughly 16% on a year-over-year basis. And you look at those patterns here over the last few months, and we are on pace for that forecast. As you look at the beef cow culling rate, well below a year ago in terms of slaughter numbers, and towards the lower end of that 5-year range, and oftentimes here below it. Now, as we do look into the fourth quarter, it will likely pick up, just as those spring calving producers interweaning calves and then culling those old and open cows. It will pick up as it always does, but remain well subdued compared to prior years. However, you look at this on a percentage basis, again, how many cows are making their way to slaughter compared to how many exist out there, and still not low enough in our estimation to really represent an expansion pace, more neutral. Historically, you need to get that culling rate down below 10% on an annualized basis to see expansion. So to us, still doesn't quite indicate that we can see growth to the beef cow herd to begin this next year, despite this dramatic decline in beef cow slaughter. Now, as we look at the heifer side of the equation, the industry entered this year with a record low number of replacements, lowest since the 50s. So it still suggests that in that 2023 born calf crop, that just not enough heifers were retained to meaningfully move the needle. So again, that certainly does limit the number of heifers that were bred this spring. Now, again, that is setting aside the fall calf crop, and those fall calving producers, how many of them kept back a few more heifers with those decisions made in the past month or two, or the next month or so ahead of us. But as you do look at heifers on feed and some other data points, does still suggest that maybe that fall calf crop of 2023, maybe it was more at a neutral pace, but in aggregate, still not enough replacement heifers out there to meaningfully turn the tide on the nation's beef cow herd. So all eyes on heifer attention this fall. How many of those spring-born 2024 calves and those heifers are kept back and bred in 2025, calving in 2026? And you think about that pattern, that implies that she becomes a beef cow. That implies that she's counted as beef cow by the USDA in January 1 of 2027 and 2027 in the second half of the year. It would also be the first time that her calves are contributing to the fed slaughter numbers, as we'll look at in a minute. So obviously a long lag as you think about these decisions. So I want to jump back, talking about the dairy side, and just really quickly here. We're still in the camp that on a long-term basis, as you look at over the next 5 years, do anticipate a fully steady to slowly growing dairy cow herd on two factors, predominantly in that growing global demand for animal protein and milk. But then secondly, can't downplay the value of that beef on dairy cross. As you think about how a Holstein steer, was oftentimes as a day old, was worth very little. And some of these day old cross prices today, up near $900 per head. However, in the near term, no doubt that there's some headwinds. Thinking about the replacement heifer shortage, and similar to what we just looked at on the beef cow side. And as the industry swung and integrated beef on dairy and breeding the lower end of the dairy herd to beef sires, it appears that did the industry swing too hard and not make sure that there was an adequate pool for placements on the back end. And that certainly does appear to be the case. So certainly eliminating in terms of the dairy cow herd, in terms of that more near-term growth. So as you think about those beef on dairy animals, continue to compose a larger and larger number and percentage of the calf crop, or in terms of fed slaughter. Our analysis would suggest around 3 million of those born in the course of 2023, and it could be a couple 100,000 larger than that as well. But bottom line, as you do look at the trajectory for growth, do you see that the big surge and the rapid growth was likely behind us? Now, the economics and just the value of that calf and what it represents throughout the supply chain does still favor that we will see in slow and steady adoption, predominantly by those in slower adopting producers that haven't integrated yet. However, the big growth is behind us, but with these numbers, our data would suggest that they were around 10% of fed slaughter next year. And again, as these larger numbers keep working their way through the supply chain and the native beef cow herd and the native fed slaughter numbers decline, suggests that the cross will compose up near 15% of fed slaughter by 2026. And as we continue to talk to folks further up the supply chain, predominantly cattle feeders, continues to be a lot of interest in these animals, from both the small feeder to the large commercial facilities. And on top of the fact that these are just many of them just high quality animals and much different than those that were produced even 4 or 5 years ago. And as there's so much more attention to nutrition, health, and genetics. And then also the appreciation just of that relatively consistent supply coming into the system. So as we talked about, still look at beef cow numbers to be down slightly to begin this next year. Not nearly the decline that we've seen the past few years. In nearly a million head decline 2 years in a row, and down 700,000 to start this year, but still smaller nonetheless. And the important point here is that if we do enter a mild expansion pace here this fall with heifer retention, and the fact that just not enough heifers were out there and likely bred this spring, does still favor that it will be a slow rebuild when it does start to occur. And much different in our belief than the last cycle. And the important thing to think about here is that as we talk about all these headwinds to expansion, high costs of capital, high interest rates, an aging producer demographic, you can kind of go on down the list, and that's drought aside. As much as these factors favor a slower expansion, does favor that again the rebuild isn't nearly as dramatic as what we saw in the last cycle. So calf crop will be lower this year as well. Number of calves hitting the ground, and again, just limited heifer replacements being bred this spring and calving next year. Pretty well paves the way that we will be smaller again next year. And the important point would be here is that it really is on out towards 2027 in our analysis until we actually do see a calf crop that's bigger than the number of animals hitting the ground here this year. Same story here as you look at fed slaughter numbers continues to decline as these smaller calf crops continue to work through the system. And you do see where we have that increase penciled in 2027. Realistically, it could be flat to slightly smaller. And important to keep in mind that if we are in the belief of that slower expansion, as you compare back to the last cycle, how much of a V bottom it was in terms of supplies, rapid liquidation, and then a rapid rebuild, the quickest rebuild that we've seen in the history of the industry. If we're a slower rebuilding pace, does favor a much more U-shaped bottom and a slower rebuild in terms of slaughter numbers. Another big factor that we've seen here in the past few months is carcass weights, up substantially from year ago levels. And by some calculations, just the year-over-year increase in carcass weights could be representing around 5,000 head per week of fed slaughter. As you think about the implications to beef production and how heavier weights are just are offsetting fewer numbers coming through the system. Cold carcass weights, we'd suggest they'd be up around 20 pounds from year ago levels. And as we look over the next couple of years, expect that trend line will continue to increase. And as you just think about price of cattle versus cost of gain, marginal revenue versus marginal cost does suggest that there is added value for every additional pound. And so the industry is certainly responding to that math and just maximizing carcass weights and maximizing those pounds per head going through the system. And just a closer illustration of that in 4-panel slide here, breaking down the seasonality of these carcass weights, what we've seen so far, plus our forecasts for both steers and heifers. And you see both substantially above year ago levels and seeing to some degree some seasonal weakness or some seasonal decline, but not nearly compared to what these long-term averages would suggest in terms of moving carcass weights lower into the spring. Now, headed forward, seasonally, we will be starting to increase carcass weights. And as you do look at these forecasts, taking them up to some pretty huge levels historically. I think the industry certainly is headed towards identifying just how big we can make these fed animals. As you look at the steer versus heifer, you can see we'll take heifers or take steers easily into new records. Heifers up as well. It's interesting. You notice that steers outpacing the trend line, heifers right on trend as you draw a trend line just back since 2000. So as you look at what this means to beef production here this year, in fewer numbers through the system, especially in terms of non-fed slaughter, cow and bull slaughter down dramatically, offsetting a lot of that with weight. In total, results in beef production down around 1.8% from a year ago, but still with cyclical downside here ahead of us as we continue to step into smaller numbers. And then on a year-over-year basis, as I jump back here, we still see carcass weights growing, but not the dramatic declines or dramatic increases, excuse me, on a year-over-year basis as what we'll see this year. Could it be larger than this? Yes, but pretty unlikely to see another 20-pound increase year over year. As you look at the balance of trade, certainly working towards fewer exports and more imports. And on the export side, and as we just produce less of it, hard to export more of it. And also just thinking about the high prices that we have here domestically, somewhat rationing that product. But certainly, as we read the markets globally, not a reflection of decreasing demand. Still, especially into the Southeast Asian regions, still very strong demand for the product, but just in high values and reduced production being a headwind there. At the same time that as we have dropped back cull cow slaughter rates, the industry offsetting that with increased imports, and predominantly in the form of lean grinds, and a lot of that coming from Australia as they've rebuilt their numbers from the drought that they've experienced. So as you look at per capita consumption, after you account for the offset of the balance of trade, imports up and exports down, per capita net beef supplies will be down just slightly here this year, but should continue to tighten here over the next couple of years, again, as we continue to produce drop down beef production. So as we flip a little bit to the demand side of the equation and just talk about the economic landscape, and just a few of the assumptions here and our quick read on the economy. Believe that inflation, while it's certainly moderated, believe that the Fed will have a hard time getting it down towards that 2%. And so still suggesting that seeing CPI inflation rates in that 3 to 3.5% rate as you look over the next 12 months or so here. Interest rates will likely see in that 1 to 2 cut, probably closer to the 1, but we'll see. But again, certainly a slower pace than what many folks hoped for. And as you look over the next few years, without that case for a severe recession, and also with the case, unless you see a dramatic drop in inflation close to that 2%, it's hard to make the case for rates dropping dramatically. A softer bias, yes, but certainly not headed back anywhere near this zero rate environment that we've been so used to. As you look at GDP growth, slower, but still growth nonetheless. Unemployment will increase slightly here from the record lows, but still remaining historically tight. And the labor market certainly supportive to the consumer and their ability to go out and find a job. And then as you look at under um, at the lower side, uh, the as you look at some of these headwinds here, certainly the savings rate does remain low. As you think about the consumer's added income and added buying power from the COVID dollars, certainly well gone. And at the same time, credit card balances continuing to move higher here. Plenty of headwinds and things that we do need to watch in terms of challenges on the horizon. But at this point, they're largely just remaining threats, more so than they are um, more than they are opening dramatic downside as you look at the economy. As we start talking about beef and how some of these shifts are occurring in the economy, one big difference we've noticed here recently is just these differing patterns between food at home in grocery store business and food away from home or restaurant business. Now, it is amazing as you look at both grocery store and restaurant prices since January 2020, so immediately pre-pandemic, prices have increased about the same percentage compared to pre-COVID. However, the path to get there has been dramatically different. Now, as you still look at these restaurant prices, restaurant operators certainly caught between a rock and a hard place. Their costs certainly have not gone down, especially on the labor side. And certainly as they try to pass those cost increases along to the consumer, they're running into a price sensitive consumer. And so that's certainly case in point as you look at, for instance, Red Lobster declaring bankruptcy and those challenges across the restaurant segment, just a reflection of those challenges there. And at the same time, you look at grocery store demand and inflation. Yes, still up year over year, and consumers still not happy about the prices that they've seen or that they're seeing at the grocery store, but no longer going up at such a rapid clip. Inflation closer to 1% there. So those differences certainly are improving demand at the grocery store level, and not necessarily a negative as you think about beef. Again, maybe less beef being moved through the restaurant pipeline, but consumers picking that up at the grocery store instead. So to that question of how long can the consumer keep paying these beef prices? A question that we get all the time. Just an illustration here. Our expectation would be beef prices averaging 7.95, excuse me, this year. Now, you look at that on a calculated demand basis, will be slightly lower than a year ago, but bottom line, you look at these numbers, it still will be the fourth strongest demand on record. And so the message would be that while there are a few cracks here and there in beef demand, in aggregate, cracks in one spot are being fully or largely offset by strength somewhere else. But we do appear to be at a fairly critical spot in terms of price, at least for the time being. It does look at like retail here at this just sub $8 area. And I think we'll run into some consumer resistance here. And as you look at this, the reason why, certainly a price sensitive consumer and the fact that there is adequate competing protein supplies out there will be limiting to retail beef prices. Now, I think this is a really interesting diagram. Looks at retail beef prices on an inflation adjusted basis. At $8 today, it's basically the same level where beef prices topped out in the last cycle at the retail level. But we can still go up, but likely tied closer to the rate of inflation. So in 3% per year on $8 would suggest around 24 cents potential upside as you look 12 months down the road. Still going up, but not at their dramatic pace. Competing protein supplies remain large, as I suggested, in terms of total beef, pork, and poultry production. As we've kept carcass weights big, so has the quality grade mix. The percentage prime and choice in continuing to run well above year-ago levels. So certainly that positive sign that the beef that we are putting in front of the consumer is a very high quality mix. However, that is limiting in terms of price, these price premiums for prime and choice, both below year-ago levels for the most part this year, but still reflecting a lot of these seasonal patterns. And not that the consumer doesn't still have a preference and is still willing to pay up for the upper tiers of quality. However, just the fact that we're producing so much more of the upper quality product, the supply effect somewhat limiting to the spreads. There was a question about what type of animal, again, for folks that are looking to expand, should we be focused on? And I think this chart does illustrate this. As you break out demand by quality grade, choice versus select, you see the clearly differing trends. And choice demand continues to move higher and is certainly moving the needle in terms of total beef demand, while select product and demand not necessarily increasing, but certainly pretty stagnant. So I think the bottom line message here, if we are looking towards expanding a herd over the next few years, a focus on quality is certainly important. But even more big picture, you know, these demand trends are certainly a reflection of paying attention to what the end consumer wants with the product. So just having that long vision in mind in terms of what is it that the consumer appreciates with our product. And so having that consumer demand in mind is the big picture message to be thinking about as if we do look at expanding the cow herd over the next few years, both on the producer level and the industry as a whole. And just an illustration of how that, those financial benefits can come back to the producer. These are net returns from cattle marketed, fed cattle, on a grid arrangement. So again, reflecting those quality grade premiums for prime, upper 2/3, and choice. And basically you can just see here that in those cattle that grade well tend to get a larger premium than those more average type of cattle. So the market certainly is passing those dollars for quality back down the supply chain and also reflected in wider ranges for some of these calf prices as well. In the interest of time, I'll work through some of these pretty quickly. Apologize, I took a little bit too long on some of these high-level slides. Box beef cutout has performed here seasonally. Do look towards some seasonal risk as we work towards late summer. Still on pace to average slightly higher here this year. As you look at the fed cattle market, we have moved into new record highs for the fourth time this year, there last week, and likely to move higher again this year. Still look towards some seasonal softening as you look towards late summer and fall, as reflected by the futures, as well as what we would just expect of the marketplace. But still anticipating that market should be well supported in that low 80s area and could be supported even closer to where futures are at that low 180s. As you look at futures, they have certainly broken out to the top side. So looking at August live cattle, should be running into some resistance in this 188 to 189 area now, but not too far from those highs that we marked out ahead of the flush last fall. Now, important to keep in mind in what does happen if for whatever reason, and you can rarely forecast it, there is a flush to the futures market. Um, Certainly one of those that again is hard to forecast ahead of time, but would certainly be a headwind as you talk about the cash market. However, in the fundamentals in both supply and demand, as we talked through, of the fed cattle market remain very strong here. Again, how do these things offset? Certainly would open up some downside, um, but just one of those reasons that we do encourage producers to be looking at risk management strategies and do anticipate that as we do butt up against some of these record highs and prior contract highs, we will be looking at some hedging pressure to the market and think in large part that is some good business to be doing, especially via strategies, futures or LRP, that continue to leave some upside potential. Because again, while we are continuing to walk into tighter numbers, as you look at on feed, is par with year ago levels somehow, as we just keep digging deeper into that feeder cattle supply. And also, again, that incentive to add weight and add days on feed results in animals spending more time within the feed yard. Another important thing to keep in mind is the regional spreads. This is looking at the price difference between Iowa, Minnesota fed cattle prices and Kansas. Big premiums up in the north as you look at it. And that's started to become more of a pattern here in the last few years. So as you do work with any producers, again, that are marketing fed cattle, again, closer to your part of the world, we do need to be keeping these seasonal patterns in mind here. And certainly you could see those patterns where does the North go discount in the fourth quarter? That's something we'll be needing to look at, but also just thinking about those premiums built here in the second and third quarters of the year. As you look at the feeder cattle supply, next turn behind them is still very tight and supportive to feeder cattle values, record high as well. Futures in still reflecting that seasonal strengthening, but a pretty flat curve as you do look at it compared to current cash prices. And we do like having some risk management in place at this lower to mid 260 area basis feeder cattle futures, but still looking towards potential for firmness beyond that, and potentially up towards that 270 mark. And as you look at it, trends for the feeder cattle still pointed higher as well. But really, as you start gauging how much potential upside could there be, it really will come down to the deferred live cattle. How much strengthening can we have to, for instance, April of 2025 and that live cattle contract, or as you look towards the summer 2025 live cattle contracts. And if we don't see substantial upside there, it will be really hard to get feeders quite to that next level. Calf prices, record strong as well, weakening from their spring highs, but not very much. And as we work towards the fall run, still do expect that seasonal softening will occur. But basis a U.S. average 550 pound steer price, we would be looking at price support there around that $3 range, and compare that to the lows of into the low 270s there through the fall run last year. And I think simple illustration here as we think about producers trying to budget in up roughly $30 per hundred on a year-over-year basis. However, in those big gains probably behind us here, but still looking at a market that's in $20 to $25 above year-ago levels. As you look at the coal cow market, extremely strong as you look at 90s lean, coming straight back to cull cows as well. Again, not uncommon to see some of these cull cows bringing up towards that $2,000 mark. Still look towards some seasonal softening as you look towards fall. Our message to producers, if you're able to, traditionally, if you're able to get a cow that you're going to cull anyway this fall, if you're able to get her to town before Labor Day, tends to be a benefit in doing so. Or if you have the ability, instead of marketing her in the fourth quarter, can you roll her into the new year, get her into the month of February? Tends to be some benefit in doing that as well as you look at the seasonality of price. So as we summarize here, the situation that we've laid out here still implies that prices do have a firmer bias over the next couple of years. You'll notice we have each class of cattle forecast slightly higher for the next few years, but also the big increase here behind us. And keeping in mind that, hey, it's a volatile world out there, and if we for whatever reason see a 10% correction to the stock market, or pick your scenario, if we do see a futures led flush, we could see some downside risk, even just for a couple months before these strong trends reemerge. But for producers that happen to be marketing during that time frame, does pose some challenges here. So as we have entered that new and higher trading range here, it does really emphasize the importance for risk management. I'll skip those last couple slides here and go straight to questions if you do have time for any of those, Micah.
Yeah, I've got three here that I'd kind of like to highlight. Thanks for covering what you did. We got through a lot of those questions that were submitted on the front end, but the first one I want to start with is what happens in a futures market free falls lower to the cash market? Any thoughts on that?
Yep, that's a really good question. And again, if for whatever reason we do see another break, correction, flush to the futures market, often for those producers that are hedged, that can be a stronger basis environment where in the cash market it will go down as well, but typically not to the degree of futures. So it ends up to be a strong basis environment that's positive for sellers. But nonetheless, it will have downward pressure on the cash market here. And just to keep in mind for folks, as we did work through last fall, when on feed went above year ago levels, and that again, there were other things going on, but this was one of the factors that did pressure the futures complex. And as we've talked through, the fundamentals remain strong, but we will have on feed above year ago here for the next couple months. Is that something that the futures market could be looking at and trading defensively? And we don't know. Maybe the strong cash market outweighs that, but just something that we do need to keep in mind.
Patrick, another thing that you had talked about was retaining heifers, and there's a question that I kind of wanted to highlight around that. The first half was when will the cow herd grow? You discussed that, and rain replenish some of the cow areas. But just from your opinion, why haven't those heifers been retained maybe as they historically had been?
That's a very good question. I think some spots last fall, Texas, for instance, they were still recovering from drought and in a pretty bad situation for a lot of folks. So they really just didn't have the capacity to retain the 2023 born heifers. But I think just also some of these other issues, again, aging producer, distrust in the market, and just that recollection of the last cycle, how it went straight up and then rolled lower and collapsed. Yeah, say that recollection of that last cycle and distrust in the market, I think is creating where folks are a little bit more cautious on expansion and retention decisions. In high cost, things like that, and And also maybe just cash flow and balance sheet considerations that for a lot of folks last year was the first really good payday. And so maybe they decided that, well, I'm just gonna go ahead and sell this heifer, put me into a better financial situation, and then decide next year, being 2024, if they're going to retain a few more heifers or not. Um, Bottom line, Mike, I think there's just a lot of moving parts, and the decisions are different from operation to operation. But I think just collectively enough headwinds there um, that have resulted in that slower retention pace to date.
The other thing that we're seeing a lot of is dairy steers. Can you talk through maybe different markets or what you're seeing on the differences between finishing out dairy steers versus the traditional colored cattle?
Yeah, good question. Good question. Was those, and I'd assume the question is referring to beef on dairy cross. Um, there, well, a few years ago, there was some hesitancy, both from the packer or from feed yards on those animals. As we've transitioned into tighter colored or native cattle supplies, um, there has grown a growing acceptance for those animals. As well as I think just the quality of those animals has improved dramatically over the last, let's say, roughly 3 years. Um, so marketing strategies, I mean, there is solid demand. Now, is it in some cases a different player? Um, might do some folks still want to focus more on that traditional beef animal? Yes, but especially at the feeding sector, there are some people like that, but there is demand out there for them. And we've also seen where a lot of those discounts at the packing level have either gone away or narrowed substantially for the cross animal.
Well, that brings us to time. So I do appreciate the insights that you shared. For those of you on the call, do know that we'll be sharing a recording of this on the back end later today or first thing tomorrow into your email inbox. And so thank you all so much for joining. We look forward to seeing you next quarter. And as always, Patrick, thank you so much.
Perfect. Thanks, Micah, and thanks everyone for your time.